Investing for retirement, USA versus Europe. Two investors. Same age. Same $50,000 starting cash. One invests in the US stock market. The other invests in Europe. After 15 years of investing, who actually gets closer to retirement? The big question, and more importantly, is retirement about having the biggest portfolio, or living where your money stretches further? Because those are not the same thing. Here's the capital crossroads twist. What happens if you take a boring, traditional portfolio and add just 10 to 15% Bitcoin? Does it speed up retirement? Or does it just add risk without reward? Disclaimer: this is not financial advice. All numbers are simplified estimates to explain how the system works. The setup, the rules are strict. Both investors are 30 years old. Both invest for 15 years. Both add $500 every month. No lucky breaks. No inheritance. Just raw compound interest. US baseline portfolio. First, the American investor. A classic portfolio: 70% S&P 500 stocks, 30% bonds. Simple. Diversified. Boring, by design. US return assumption: we assume a 5.5% real return. This is considered a safe, long-term assumption for a balanced US portfolio. US result: after 15 years, that $50,000 plus monthly investing grows to roughly $460,000. Not bad at all. But is it enough to retire in America? EU baseline portfolio. Now the European investor. A similar strategy, but slightly more conservative returns. We assume about 5% real growth. European result: after the same 15 years, the European investor ends with about $430,000. On paper, the American wins by roughly $30,000. Cost of living reality. But here's the plot twist. In the US, a $460,000 portfolio safely produces about $1,500 per month. That barely covers rent, health insurance, and basic living in many cities. The American still needs a job. The EU lifestyle effect: in Europe, that same monthly income often goes much further. Lower healthcare costs. Cheaper public transport. Lower baseline expenses. With less money, the European investor may feel more free. Adding crypto. Now let's press the accelerator. What if both investors allocate 15% to Bitcoin and keep the rest traditional? Volatility warning: crypto isn't magic. It's leverage. In bad cycles, it drags the portfolio down. In strong cycles, it can add $50,000 to $100,000 over 15 years. The 15-year verdict: the US investor often ends with the bigger number. But the EU investor often ends with more freedom. Wealth isn't just what you earn. It's what you get to keep. And what you need to spend. Your 5 minute challenge. Here's your challenge. Open a compound interest calculator. Run your own numbers for 15 years. Find your personal freedom number. Because clarity beats guessing. Comment US or EU below based on where you'd rather retire. Subscribe to Capital Crossroads for the bridge between real estate, stocks, and digital assets.